Hi everybody, it's Paul Sydlansky and welcome to episode 19 of The Build, our 24-part planning series where we take you through the life of a plan with Lake Road Advisors. Today we're going to talk about taxes, an extremely important part of any solid financial plan. What we're going to do though, since there's so many different areas to talk to, we're going to lay the groundwork and provide you just a basic understanding of how our tax system works. And we're going to talk about the difference between marginal and effective tax rates. Our system is a progressive tax system, which basically means that the more you make, the more you pay. And now, understanding the nuances and the differences of our tax system is critical when building a plan. Take a look at this slide from our friends at VisiWealth, and you can see the tax brackets in the top left-hand corner. And column 1 is a single filer, and the second column is a person who is married filing jointly. Both groups start out in the 10% tax bracket. However, you can see the single filer only goes up to $10,275, where the married filing jointly filer has double that. So what that means for a single filer, the first $10,275 of income is taxed at a 10% rate. Now, the next dollar after that $10,275 is now taxed at the 12% rate. And that 12% rate holds steady up into $41,775. So you can see here that the more you make, the higher your marginal tax rate is. Now, looking down at the bottom here, you could see something called effective tax rate. The effective tax rate is the total blended rate. This is the rate that you get by taking the total tax you pay and dividing it by your taxable income. If you look at the 4 examples below, you can see the first one, a single filer who makes $150,000 in income, has taxable income of $137,050. This individual, she is paying an effective rate of 19.5% and a marginal rate of 24%. Now, over in the second column, you have somebody who's making $150,000. However, they're married filing jointly. Their taxable income is lower because they have greater deductions. With a married couple or a married filing jointly, generally you're going to have 2 standard deductions. In this case, this individual has lower tax liability and has an effective tax rate of 14.94%, or about almost 5% lower than the single filer. So you can see how being married in this case and making the same level of income means you're paying really a lot less in taxes. Going to the right, you can see 2 more examples of taxable income of $300,000. These 2 individuals are, one is in the marginal 35% rate, and on the far right is in the 24% marginal tax rate. And the $300,000 earner, the single filer, is an effective tax rate of almost 26%, where the married filing jointly filer has about 20%. So again, understanding these differences is critical when planning for your taxes. Now that you understand the differences between marginal and effective rate, next time we're going to show you how to best decide whether to invest in a traditional 401k or a Roth 401k and which one makes the most sense for you. Thanks for your time, and we look forward to seeing you in our next episode.